It remains very important that you are able to see how the consolidation journal entries pulls through in the consolidated financial statements. In this example, for purposes of the consolidated statement of profit and loss for the year ended 20x10, we were only provided with profit for the year. So the effect in this example is that 20,000 Rand additional deficit that was necessary in the group that we have adjusted for through Consolidation Journal 1 would decrease the profit of the group by 20,000 Rand. Typically, that 20,000 Rand would have been adjusted for in the line other expenses would you be able to do a detailed statement of profit and loss. The consolidated statement of profit and loss is never complete until you've done the portion where you attribute profit to the owners of the parent and non-controlling interest at the bottom. What you had to pick up here was that the portion of profit attributable to my non-controlling interest at the end of 20x10 is that 11,000 Rand that we've calculated in Journal 4. The portion attributable to the owners of the parent becomes the balancing amount to balance back to profit for the year. Because we didn't have any other comprehensive income items during 20x10, the portion attributable of total comprehensive income is exactly the same as profit attributable. This is the analysis of equity of example 7.5. The purpose behind the analysis of equity is to identify, first of all the equity items of the subsidiary, how much of that is allowed to be in the group, and then attributing that to the parent and NCI. In the at acquisition section, you will see that the revaluation surplus of 20,000 Rand is now included as part of the at acquisition equity. That gets eliminated against the cost of the investment and the measurement of NCI at acquisition date. Because NCI is measured at their proportionate share, they also get a portion of that at acquisition revaluation surplus as part of their at acquisition measurement. In the period since acquisition to opening balance, you start with your trial balance opening retained earnings or equity amount. You adjust that for the effect of any consolidation journal entries written to that account. In this example, it is the 7,500 at acquisition retained earnings that eliminates. You are left with 10,000 Rand, which is the retained earnings of S that's allowed to be in the group. That then gets attributed to my parent and NCI. In the current reporting period, the only movement in equity identified is profit for the year. I start with the profit on the TB. Please remember, the 35,000 was purely listed as a separate line item. That is then adjusted for the effect of those consolidation journal entries that change the profit of the group and specifically the profit of the subsidiary that's included in the profit of the group. That is now adjusted for the 20,000 Rand additional revaluation deficit required in the group, which would reduce the profit of S to an amount of 55,000 Rand. That is now the profit of S that's allowed to be in the group, which gets attributed to the parent and NCI. Please remember these amounts in your P limited and non-controlling interest columns, as it is very useful when we prepare the statement of changes in equity. This is the consolidated statement of changes in equity for the year ended 31 December 2010 of example 7.5. My share capital always remains only that of the parent because the subsidiaries gets eliminated through the at acquisition journal entry. The non-controlling interest amounts can be obtained from using the analysis of equity. The opening balance would be the at acquisition measurement plus the since to opening balance portion attributed to NCI. The profit for the year is the profit of S attributed to NCI. In this example, there was a revaluation surplus necessary on the land of the subsidiary at acquisition date. Why do we then not have any amounts for revaluation surplus in the consolidated statement of changes in equity? The reason for that is because the 20,000 revaluation surplus that you've created at acquisition date got eliminated through the at acquisition journal entry, because there's no other revaluation surplus amounts in either the parent or the subsidiary. There's no revaluation surplus in the group. We will now focus on the calculation of the opening retained earnings, calculation E, and profit for the year, calculation H. Because we already looked at the analysis of equity, we will follow the alternative calculation. The opening retained earnings of the parent is 57,000. To that we add the portion of the subsidiary's retained earnings since acquisition date that was attributed to the parent. The profit of the parent is 120,000 Rand from the trial balance of P. To that we add the profit of the subsidiary attributable to the owners of P that was calculated on the analysis. Please remember that the profit of the subsidiary was already adjusted for the effect of the 20,000 additional deficit on the analysis of equity. Once these amounts have been calculated, remember to transfer them to your actual statement of changes in equity.